Did you know that if you take too little risk or too much risk, you actually could run the risk of running out of money? In this episode of the Retirement Planners of America podcast, we're going to discuss both sides of that and help you to see how much risk you should take.
Retirement Planners of America, RPOA.com.
Hello, RPOA Nation, and welcome back to another episode of the Retirement Planners of America podcast. I hope this finds you healthy, wealthy, and wise. And in this episode, we're going to be talking about how much risk is appropriate for you. And we're going to go into a discussion of the different levels of risk and how to control risk, okay? And I want to refer you to, if you haven't watched it or listened to it already, to our podcast on the RCFP, the Retirement Cash Flow Plan. Easy for me to say. In the Retirement Cash Flow Plan, we go through the whole gamut of how we calculate the rate of return, the amount of risk, all of that. In this episode, we're going to talk about the next step in that process. Okay, so if you haven't watched that one or listened to it, make sure you do. Even if you're out of order, do it anyway. Okay, so again, this week, this episode, Jeremy, we're going to talk about how much risk. And by the way, this is Jeremy, my producer, my co-host.
Yes, indeed.
Formerly known as Jer Bear. I'm actually never going to let you.
I've been able to tell every time we start the intro.
I love Jer Bear.
Yeah.
I wish we could keep Jer Bear, but he, ladies and gentlemen, he does not want me to call him Jer Bear. Therefore, I will not ever use the word Jer Bear when I'm addressing you, other than to remind everybody of your former.
Right.
You're the artist formerly known as Jer Bear.
Right.
Okay, so this week, so we're going to talk about the different kinds of risk, and then also we're going to illustrate, how diversification and those kind of things help in that regard.
Absolutely. Yeah. And I think it's super helpful to remind people that this is not a one-time deal. Again, that RCFP, the acronyms abound in our industry, is something to be done frequently.
Updating the retirement cash flow plan. We want to update it at least twice a year.
Yeah.
Because things change.
Right. So updating that, and then this, again, is just kind of attached to that. We didn't want to make a 2-hour-long video essentially talking about the whole thing.
We don't?
Right. My attention span isn't that great. But yes, so talk about risk and what risk is appropriate to you and kind of how, I guess, the market looks at it and how we specifically look at that.
Yeah. Before I do that, I have to make my compliance department happy. Okay? And so I have to say that the opinions expressed on this show are my own, nobody else's, although they ought to be, as far as I'm concerned. Future results are not guaranteed by the past. And what else am I supposed to say? Diversification is not a strategy without risk. And also that there's no one size fits all. So in case anybody didn't know that, had never heard that before, we just did it just to make sure that we're on that.
Yes, yeah.
I always love compliance. They're like the show downer. They do that. But anyway, yes. So the amount of risk. So our philosophy is that you should only take as much risk as is necessary to accomplish your financial goals.
Right.
Okay, and so we keep mentioning the RCFP, so I apologize for that. But basically, what that helps us to understand is, how much risk do you need to take to accomplish your goals?
Right.
And so once we've determined that, then the exercise we're going to do on this episode is to help illustrate why that amount of risk is appropriate. Mm-hmm. But here's, I'll give you an example. Let's assume for a moment that you won the lottery.
Ooh, I like that idea.
You like it?
Yeah.
So far, so good?
Yeah.
Okay. So you win the lottery, and this isn't the Powerball where you win, I don't know, $10 million. No.
Okay.
You're going to win $1 billion.
Ooh, is this a Saudi Arabian
No, this
Powerball?
So you're going to win $1 billion. And so now you want to invest that for your retirement. Okay. So we want to determine how much risk do we need to take for you.
Yes.
Okay, so the way that we determine it is by using the retirement cash flow plan that we talked about.
Right.
Okay, and in that exercise, let's say that we find out that you want to spend, and I know this is going to be hard for you to be able to do, but you want to spend $9 million a month.
Wow, that's it?
Yeah.
Oh.
Yeah, that's where you are.
That's rough.
So that's $108 million a year for your cost of living.
Yeah.
But you're thinking, I have $1 billion.
Right.
So
That's nothing to me.
That's nothing, right? Well, that's actually taking out 11% of your money. Okay.
Yeah.
So if that's the case, then we have to take a higher level of risk to be able to satisfy that 11% that you need to take out.
Right.
Now, what we would encourage you, because we believe that you should only take as much risk as is necessary to accomplish your financial goals.
Right.
And in this example, if you're taking out 11% every year, even though you're a billionaire, I would suggest to you that you're going to run out of money.
Yeah.
I mean, think about it. If you're taking out, let's shrink it. Let's call it 10% a year. You know, without any gains, just straight up math, it's about 10 years your money's going to last.
Right. Right.
And you're 10 years from now, you'll still be a young man.
Yeah, right.
Right?
Yeah.
So what we would instead suggest that we only take as much risk as is necessary to accomplish your goals. So, Jeremy, let me ask you, could you, okay, I'm really going to ask you to sacrifice here.
Okay.
But could you live on $1 million a month?
Man, that sounds like I'm living off of Spam and crackers.
Yeah, I know.
That's rough.
I know. It's tough. Yeah, but if you could live
Yeah.
on $1 million a month, on a mere $12 million a year, that would be 1.2% of your total money.
Yeah.
So in one scenario, you would run out, and in the other scenario, you probably would never run out.
Yeah.
So the amount of risk you take that we determine is important. Generally speaking, we like to keep the risk level and the return. So there's that risk-return relationship.
Yes.
So the first thing I want to do is I want to go over with you what is called the efficient frontier.
Ooh.
Yeah, doesn't that sound cool?
Yeah.
I think it's cool. So I'm going to open up my computer here. Okay, so Jeremy, what I want to do here is I want to show you on the screen what is called the efficient frontier.
Yes.
Okay, and this helps us to determine how much risk, how to construct the portfolio that is appropriate for you given the risk that we want to take.
Right.
Now, keep in mind that the first part of this, as I just described a minute ago, is that we want to take the least amount of risk possible.
Right.
So in the example that I gave, and you've got your $1 billion and you want to spend $9 million a month and take 11% out, I'm going to tell you can't do that. Yeah. All right. Now, you can fire me for that, but I'm of no value to you if I just tell you what you want to hear.
Absolutely.
Okay. So the first thing I would say is, no. We cannot. You can't sustain an 11% withdrawal rate, for the rest of your life. That I would feel very uncomfortable with that. I would try to push you down. Yes. And I exaggerated with the million, because I know you could never live on $1 million a month. Right. That'd be too tough for you. But maybe we can get it down to $2 or $3 or $5 million a month, and get it down to maybe 6%, 4%, somewhere in that range. Yeah. As to what your withdrawal rate is. Yeah. And so if we do that, then we have a much better chance of having your money last as long as you do, which is our goal. Yes. Right? We have two goals for our clients. One is we want your money to last as long as you do. Right. And secondly, we want you to have financial peace of mind. Yes. And by the way, just as an aside, I think I've told this story before, but when we were deciding on that, that tagline, I'll call it, of we want your money to last longer than you do. Yeah. We surveyed our clients, we always do, and we asked them, we said, what do you think of that? Yeah. And they said, we hate it. And you hate it? Why? Why? Why would you hate your money lasting longer than you do? That sounds like a good thing, right? Yeah. Well, because I want the last check I write to bounce. Okay, I've done my work here is done. Yeah. The kids can fend for themselves. So we said, all right, well, what if we change it to we want your money to last as long as you do? Yeah. And then they were like, There, I like
Yeah,
that one much
yeah.
better. So that's why we use that instead. It doesn't mean that we can't design a plan with the goal being that you have more money than you have today.
Yes.
But it was kind of a funny.
Yes.
It was funny. We thought it was
Yes.
funny. Okay, so anyway, so this chart here that I'm showing you is called the efficient frontier. And the reason why it's called the efficient frontier is because this curve that you see here, okay, basically shows you different percentages. And so up and down on the left-hand side, that's the return, right? So the higher up you go, the higher your return is. And then along the horizontal axis, the farther you go to the right, the more risk you're taking. Okay. So what you can see here is, for example, is that 100% stocks is the highest risk portfolio.
Yes.
In this example.
Right.
And the least risk is, interestingly, is a 30 stock and 70 bond portfolio.
Yeah.
And most people would think of bonds, 100% bond portfolio, as the
Right.
least risk.
Right.
But as you can see here, when you look at the efficient frontier, it actually isn't. Okay.
Yeah.
So
A boomerang effect.
it kind of looks like a boomerang, yeah. So one thing you'll notice here is that the one that has the least amount of risk is this 30-70. I call this the alchemy of diversification. Okay.
The philosopher's stone here.
Yes.
Yeah.
And the reason why this happens is because that's the value of diversification.
Yes.
Okay, because as we've noticed in previous years, the bond market doesn't always go up.
Right.
And as we've also noticed, the stock market doesn't always go up. So they kind of zig and zag, And so if you combine the two, then in many cases over time, what they can do is they can take the edges off the top, the spikes on the top side, and they can also potentially take the spikes on the bottom side as well,
You're right.
and smooth it out.
Yeah.
And then that reduces your overall risk.
Yeah.
Okay. And so that's why the lowest risk portfolio over this period, and this is according to the source here, as you can see, is BNY Mellon, is the 30-70, 30 stock, 70 bond.
Yeah.
So for somebody who wants to take the least amount of risk, that's what we would maybe recommend. Okay. So as you go up the curve, you can see that you can go all the way up to 60-40, 70-30, 80-20, depending. So if we're looking at how much return we want to make,
Right.
okay, so we're looking at the up and down here. What we want to do is say, okay, if our goal for your cost of living that you want to support with your $1 billion is a certain percentage, then what we do is we say, okay, that percentage, let's say, is right here, and that coincides with the 60-40 portfolio.
Yes.
And so that's the one that we would probably use for you,
Right.
because it will give us the highest probability
Yeah.
of achieving that goal.
Yeah. And we're talking about, when we say 60-40 and 30-70, things like that, we're talking about the amount of your investments that are in the stock market, which in this case we're talking about the S&P 500, and the amount that is in the bonds market.
Yeah, and in this example, we're using the U.S. bond aggregate index.
There you go. Yeah, there's no way I knew that. I just
that's
knew
a good-
it says bonds.
That's a very good question. So the protocol is that the first number is stocks and the second number is bonds. So if I
Yes.
say 60-40,
Yeah.
what I mean by that is 60% stocks, 40% bonds,
Yes.
etc. So in most cases, for most people, what we try to get you in, if you are a retired person, okay? And we call our clients that are retired squippers. And for those of you who don't know what squippers are, well, squippers is the acronym for second childhood without parental supervision. So when a client of ours retires, we call them a squipper, and we tell them to get out of here, stop bothering me, go play, have fun, enjoy. Let us worry about this stuff for you so that you don't have to. So for our squippers, we try to keep them in the 60, 70-ish kind of range.
Yes.
Okay, which means that most likely, if their cost of living is too high, we need to get that down
Right.
so that we don't have to take a higher amount of risk to
Right.
cover their cost of living.
Right.
So again, we always say we want to take the least amount of risk possible to still achieve your financial goals.
Of course.
Right? That's a core value, an investment principle rather.
Yes.
So what you can see here then is on this chart is the progression of the stocks and bonds and the return and risk equation. The next thing that I want to show you guys is this chart over here. Okay, so once we've determined the rate of return that we need to accomplish,
Right.
the next thing is we look at the Callan chart, which is the efficient frontier, and it's a scientifically calculated.
Right.
Okay, it's a
Data driven.
It's data-driven,
Right.
scientifically calculated, and the efficient frontier is something that's been used for decades.
Yes.
And basically, it's the least amount of risk for the highest return,
Right.
given what you're looking to achieve.
Right.
Okay, so that's the goal: is to take the least amount of risk possible and still
Yes.
get the rate of return you're looking
Right.
for.
Right.
So once we've determined what the portfolio is, let's say it's 60-40, 70-30, I want to show you something else
Okay.
that is really interesting. And that is, how you diversify. So if you say, I'm going to be 60% in stocks or 70% in, what are you going to have in your portfolio?
Yes.
Okay, so this chart right here is called the Callan chart. And maybe it's named after Mr. Callan. I don't know why it's called the Callan chart, but it is. So this is through the end of 2023, and it shows you from 2007 all the way over. And what you can see here is that each column is a year.
Yeah.
Each color is a kind of investment. At the top is the highest performer for that year, and at the bottom is the worst performer for that year.
Okay.
Okay, so this is very instructive. So let's look over here. In 2007, you can see that emerging markets, which is the economies that are growing hopefully rapidly,
Yes.
like South America, Southeast Asia, those kind of things, not the
Yes.
established countries like Europe, Japan, United States.
Right.
So that's emerging markets. And so it's this salmon color over here. And by the way, if you can't read all the stuff on here, that's okay.
Yeah.
If you can,
Yeah.
you have like Superman eyes, okay? You can like magnify. I admire you for that, but you don't need to be able to read anything on here. Just notice the colors, okay? So the salmon color right here is emerging markets. So you'll notice that it went up 39% right there. So something that goes up 39%, what does that do? Holy cow, that
Yeah.
attracts a lot of attention.
Of course.
So everybody loaded up
Yep.
on emerging markets. Man, you got to be in that. If you're not invested in emerging markets,
You're missing
you're
out.
missing out,
Yeah.
right? And you don't want to miss out. So there's a huge buy. Well, that was a mistake because you can see that the following year, those emerging markets lost 53%.
Jeez.
Yikes! Ouch! Get out! Sell!
You're right.
So everybody then sold all those emerging markets.
Yeah.
Well, that was a mistake because the next year they went up. Are you ready for this? 79%. Oh my gosh!
Golly.
Yeah, we should buy them. Buy emerging markets. If
Yeah.
you don't have them, you're crazy. You're missing out. And guess what happened next? Boom! It went all the way down, and it was down 18%.
Wow.
And now it's sell. Well, you may say, okay, well, that's the salmon color. Well, this gray box over here, this is core fixed income. So these are bonds. This is
Okay.
the aggregate I was talking about
Yes.
earlier. So in 2008, it was the best performer because the stock market was crashing and
Right,
people were
everyone was buying
scared
it.
and they were buying bonds, right? They were trying to find safety. So they bought bonds, and bonds was the best performer. You should be in bonds, buy bonds, buy bonds. Well, you can see that it went to the bottom, and then it went back up to near the top. And then it went back down to the bottom, and it went back up to the top. So the
Yeah.
gray box did it too. So
Yeah.
that and if that's not a convincer, let's look at large cap stocks. Okay, this is the thing that we've seen the FANGs for those of you
Yes.
who remember, which is what Facebook and Amazon, et cetera, and then the Magnificent Seven, which are the AI companies. So these are the large companies, and you can see here the baby blue color was at the top, and then it stayed at the top for a while. So of course you must have that, but then it went all the way down to the bottom here, and then it went back up to the top. So pretty much you can pick your color,
Yeah.
and it did it.
Right.
Okay.
Right.
So what this shows, if it shows two things. One is that you cannot predict next year.
Correct.
Okay. It is just very unpredictable. It could be at the top, and people tend to chase returns. But when you do that, you end up taking more risk because if you're chasing returns, you're chasing the thing that everybody's buying.
Right.
And to quote Warren Buffett, if everybody's brave, I'm a coward, and if everybody's a coward, I'm brave.
Yeah.
So what happens though is all the headlines are, emerging markets are doing fantastically well, or large cap, or technology, or whatever the soup du jour is.
Yes.
And of course, everybody's loading up on that.
Right.
But when you do that, you're taking more and more risk.
Yeah.
Because the thing that's the high flyer, you can see it. History tells us is most likely to be the one that goes down next, and but you can't predict it.
Right.
And you can't predict that the ones on which ones are on the bottom and when they're going to go up next.
Yes.
But you can say that over time, what's at the top will go to the bottom, and what's at the bottom will rise to the top.
Right.
Okay. So diversification, if nothing else, this shows you the importance of having a diversified portfolio.
Yes.
Now, you may notice the purple box across the middle. Whenever I show this chart, everybody fixates on the purple box. I want that one.
Yeah, steady.
Okay, because it's like steady Eddie over here. It does have a little down period, but even then, what is that, a 13% return? That's not shabby. But if you look at all this period of time, it did have some bad years, but overall, diversification, you can see here in the purple box is a steady Eddie. And so, when we talk with clients, we have two kinds of people that we work with, clients and squippers.
Yes, right.
Okay, clients are people that want to become squippers.
Yeah, absolutely.
And squippers are the people that are looking at the clients and saying, ha, 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 ha.
Yeah.
So when we're looking at diversification, we have different levels for a squipper versus a client.
Yes.
But the importance of diversification is, I think, very well illustrated by that purple box there. And that's the 60 stock, 40 bond portfolio is what that is. Now, one thing that I think is very important, Jeremy, and that is, we've talked in the past about the three worst enemies you have to your financial well-being.
Right.
Right. One is taxes. Mm-hmm. The other is inflation. And what was the third one again?
It was some kind of animal. Was it a wombat?
No.
Could have been a bear?
A bear.
That's it.
It's a bear, yes. Kind of like Jer Bear.
Yeah.
Which is no one in this room.
Right, correct. Right. Yes.
So, yeah, bear markets. Mm-hmm. And so, even though diversification is wonderful and everybody loves it, what you'll notice is that you can still, in 2008 over here, you can still lose 28% of your money. Oh, yeah. And there are other periods of time when you could lose a significant portion.
Of course.
And so diversification is very, very important. And in another episode, we're going to talk about how to use the information on this chart to our advantage. There's a strategy called rebalancing, where you don't know exactly when the one on the top is going to go to the bottom and the bottom is going to go up to the top, but you can use that information, that knowledge to your advantage. So there is a different video, a podcast we'll be talking about with regard to that. But the important thing about diversification is that it's not enough.
Yes.
In our view.
Right.
Okay, because it does not address the third worst enemy to your financial well-being, which I should say is the first, and that is bear markets.
Right.
And the big bad bear markets are not frequent.
Right.
But they do happen.
Mm-hmm.
And
frequent enough.
If you're going to be retired, hopefully, 30 years, the likelihood of you experiencing one is significant.
Yes.
Okay. We had Y2K, where the S&P, the stock market, went down 49% from peak to trough. We had 2008, where it went down 57%. So we do have, and they happen.
Of course.
And if you don't plan for them, I think it's unwise, right? You're not being. I don't think you're being very smart if you don't plan for those kind of things. So having a strategy to address those is very important. So diversification is good.
Yes.
But making sure you have a strategy to protect against bear markets, I think, is even more important than diversification. And I remember back, I was talking to he's now a squipper, but he was a client at the time, and he was saying that in 2008, when the stock market crashed, and I actually met him in 2009. He had enough of buy and hold, and it's going to come back. He had lost so much money, and he said he went and talked to his financial advisor about. He says, "I'm losing so much money. How do we got to stop the bleeding?" And the financial advisor said, We're diversified."
Yeah, all right.
And he goes, "Diversified?" So he goes, "Yeah, look, the stock market went down 57%. You only went down 35%.
Oh, right.
He was like, "What? Are you kidding me?
Yeah.
You call that good?"
Yeah.
And he goes, "Yeah, you should be thanking me. You should be buying me lunch.
I'm minimizing your losses.
I made you lose less than you would have."
You're beating the market.
So for us, there's a difference between relative returns and absolute returns.
Yeah.
Okay, so for us, it's not about doing better than the market in a down period. We want to mitigate those losses in a down period. Okay, so for an investment manager who runs, let's say, a stock mutual fund, what they want to be able to say is that compared to their peers, they did better in the good times and the bad times.
Right.
But that's relative returns.
Yeah.
So if the market went down 57 and you went down 40,
Right.
then that's a win.
Right.
But we don't think that going down 40 is a win.
Right.
Okay, so relative returns for us are not good because our squippers cannot handle,
Right.
a 40% drop.
Maybe a 20-year-old. Maybe a 20-year-old that doesn't have that much, but he has a lot of working years ahead of him. But if you're a squipper or soon to be one,
Yeah,
you don't have all those years to recover.
correct. Yeah, exactly. Especially, I would say that once you get within 5 years of retiring and becoming a squipper, I think that's when you really need to start thinking about how do you protect it.
Yeah.
Okay, because that 5 years before you retire is crucial.
Yeah.
And then the 5 years after you retire is also crucial. So that decade, we call it the single most important decade of your entire financial life.
Yes.
So today we've talked about the risk versus return.
Right.
We've talked about our philosophy of take only as much risk as is necessary to accomplish your goals, and we always try to push our clients and squippers down to the lowest risk possible.
Of course.
We've talked about how to construct a portfolio so as to get whatever that return is.
Right.
We've talked about diversification and how different asset classes behave. But then once you've done all that, as I said, our view is it's not enough.
Yeah.
Because if you are in that decade and you take a big loss, it could cause you to not be able to retire like you wanted to. Unfortunately, I met a lot of people in Y2K and in 2008 who had such devastating losses that they could not retire when they wanted to. A lot of them, basically had to wait another 5 or 6 or 7 years, because they had lost so much. They had to wait for it to come back. And that's terrible. We don't want that. And then for people who are retired, if you lose that kind of money, it changes everything.
Right.
So I guess what I'm trying to say is that everything we talked about in this podcast is super important, and we do all of that, but it's not enough.
Yes.
You need to have an overlay strategy, in our view, if you're in that decade.
Right. Yeah. No, I totally agree. It's kind of like making a game plan for we'll just use football as an easy analogy, making a game plan for a football game and not taking the weather into account. You're not playing in an arena. Mother Nature's going to come by and it's going to decide things for you.
Man, you're making me remember a game back when in Thanksgiving game with the Cowboys.
Yeah.
Oh my, Leon Lett. I'll just say that name, and he was a great player. But on that day, that's a day that will live in infamy for those of you who are Cowboys fans and who are old enough to remember that. But anyway, so that's our conversation for you today. So the important things, as we said, is yes, you should have you should determine what portfolio is appropriate for you given the risk that is appropriate for you, and then diversify accordingly. And hopefully this podcast and the charts we showed you are beneficial. And I hope this video finds you healthy, wealthy, and wise. Make sure you like and subscribe, okay? Don't just watch this video all the time. Subscribe to it. Like it. Help us out. And then also make sure that you subscribe to our market alert video. So we send this out on a weekly basis. We talk about our view of where the markets are going, what's happening with the economy, and more importantly, what you should do about it with your investments. I think you'll like it and find it very valuable. So once again, thanks for watching, and we'll talk soon.
Retirement Planners of America, RPO.